Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
Market jitters, bond sell-offs, extreme fear, rise in volatility. Panic at the disco? Panic or not, it's certainly getting exciting. In this episode, Greg Canavan and I covered the latest moves in the bond market, the Reserve Bank's latest decision, fearful market sentiment, and the outlook for key commodities. Greg thinks the markets are not at a capitulation low just yet, and more volatility is in store. So is this a time for panic? Not necessarily. For the steadfast investor, now is a great time to look for discounts. Hello and welcome back to the 20th episode of What's Not Priced In. Greg, it's been a journey. 20 episodes. It's pretty impressive.
Well, so far so good.
Yep.
But plenty more to go. So let's keep
Exactly.
into it.
Yeah, exactly. Well, by the way, before we start, last week we sort of mentioned that it was going to be a big week in football, NRL and AFL. Did you watch the game last week?
Certainly did. The NRL game was an absolute cracker. So, going for Penrith, very happy to see them get home at the end. It was just one of the better games that I've seen in a number of years. It had a real sort of state of origin vibe to it, and just intense throughout the full 80 minutes. I didn't catch the AFL one. I had to take my family to the airport, but I was listening to it on the radio, and it's always tricky listening to AFL on the radio. I always find it hard to envision where they are on the field and stuff like that. But that also sounded like a good game, but not if you're from Brisbane. Pretty average weekend.
That's a horrible weekend for Brisbane fans. Yeah, I watched the AFL final. It was very close, very great game.
Yep.
But before we even get into it, there was last week I sort of mentioned that there could be a new drinking game every time you hear higher for longer. And then someone made a comment, I'm not sure if you saw it on the YouTube channel, that said that the better drinking game would be if they take a shot every time I nod at something that you say.
Yeah, I thought that was a bit harsh, really, because one of the just automatic body responses that you do when someone's talking is just to nod along.
Yeah, exactly.
It doesn't necessarily mean that you're agreeing with everything I say, but so
so this episode I'm not going to nod at anything.
Slack, mate. Yeah, exactly. You just sit there and don't respond to anything.
I'll just keep shaking my head.
Yeah, exactly. And then you get some criticism for that.
Yeah, no, but it's all good. It's all banter. It's all the What's Not Priced In banter with our community.
Exactly.
Well, anyway, enough of me talking nonsense. I think we'll get into the market straight away, and it's been a pretty wild few days. We're recording this a little bit early. We're recording this on Wednesday morning, but markets are definitely selling off, and bond yields continue to rise, and it's starting to get a little bit exciting.
Yeah, well, we talked about this maybe a month or so ago, where we said the momentum trade was starting to break down. And obviously we're seeing that in a lot of the tech stocks, and you're seeing a lot of selling coming into the NASDAQ. But the driving force behind all that is the higher for longer mantra. So take a shot, higher for longer. Everyone is getting behind that now. And that is increasingly a consensus view. And I think it's probably as much of a consensus view as I've seen in the market all year. Central banks have really done a good job in jawboning that through to market participants, and even yesterday with the RBA's rate decision, there's still, to me, it actually read a little bit more dovish. Like if I'm just looking at the final paragraph of the statement, it said some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame. But that will continue to depend upon the data and the evolving assessment of risks. So I think it's almost like they've got to say that. They've got to say that their bias is towards tightening, but they don't really want to continue to tighten further, knowing that the economy is growing below trend. But they need to sound tough, and they need to sound like they are willing to move again if inflation is stickier than what they should. And the same thing in the States overnight. A couple of Fed Fed governors came out and sort of said that they're going to look to potentially increase rates one more time. And to me, that's just emboldening the short-term traders who are really getting behind this short treasury trade. And you saw US yields rise to 10-year bond yield rise to 4.8% in the US overnight. And that's up 60 basis points in a month. And it's a similar move for the Aussie 10-year bond yield. I think that was finished around 4.64%. That's up 60 basis points as well. So there's just been this huge sell-off in the bond market. And obviously that's the risk-free rate. So that puts pressure on a stock market that is relatively overvalued. So maybe we'll, in a moment, we can go through and look at the indices and just see where we are in terms of the shorter term trading, because I think we are getting to a point where there's a lot of fear in the market and we're getting to an oversold level, which those conditions generally are conducive to a bit of a short term trading bounce.
Yeah. Well, speaking of central banks, there was definitely one of the more hawkish ones, which was I think the president of the Cleveland Fed, and she sort of said that she would actually likely vote for a rate increase in November if the US economy remains as strong as it was in September. And she also made a speech or an address a few days ago, and she did say that while the Fed is making progress on inflation, the level of inflation is still too high, which is basically what I think central banks across the board have been saying for pretty much this whole year. And she did sort of say we are likely near or possibly at the peak of the Fed's fighting rate. But she said now the task turns to ensuring that we keep monetary policy restrictive for long enough to be confident that inflation returns to our 2% goal in a timely way. We are not there yet, but we will get there.
Yeah, and I think in many ways they've painted themselves into a corner in that they literally have to see near recessionary conditions pick up in unemployment in order to get that inflation rate down. Inflation is a lagging indicator. So by the time you see inflation down to levels they're going to be happy with, the economy will have slowed significantly and quite possibly in recession. And I was just looking around yesterday because we haven't done the magazine indicator for a little while on this show. So I noticed I'll just share a what do you call it? An indicator from or the magazine cover from Barron's magazine, which I thought was quite interesting. So it says the extraordinary labour market, and I think this is a good indicator to say that the labour market will show signs of weakness pretty soon, because like inflation, employment or unemployment is a lagging economic indicator. You generally don't see it until after the slowdown has really kicked in. And I think one of the key narratives behind this higher for longer is that the labour market remains really, really strong. And while ever the labour market remains strong, that's providing concerns for central bankers. It's providing upward pressure on interest rates or bond yields, and it's putting pressure on stocks as well. So I think that almost the final leg of this downturn or this slowdown that we're seeing and the stock market starting to price in is an uptick in or weakness in the labour market. And right on cue, Barron's has come out with a pretty cool magazine contrary indicator to suggest that might soon be about to happen.
Yeah, and I think I think it's definitely. I think some people are saying that this potentially could be the top in the bond yield trade, especially when I think on one of the American talk shows there was a financial talking head who sort of said that he thinks potentially bond yields could hit 16%. And I think that sort of went a little bit viral in the financial community because it was such maybe a bit of an extravagant call, but it sort of suggests that I think maybe the top is near in that trade.
Yeah, I think when people have the confidence to come out and say stuff like that, I mean, 16%, that is, it's a pretty insane call. When people have got the confidence to come out and say that, you know that things are getting pretty crazy. Technically, and we'll look at some charts in a moment, but technically the bond market looks really, really ugly. But certainly from a fundamental perspective, yields at 4.8% in the US, a long-term risk-free bond yield. When I say risk-free, it's obviously, you're guaranteed of getting your principal back, and the question mark is how inflated away that will be over time. But 4.8% in a slowing economy is a pretty good bet. And in a slowing economy, when stocks are valued still pretty richly, to me, the risk reward of bonds versus equities is heavily tilted in favor of bonds at the moment. From a broad market perspective, I think there's certainly equities in Australia, especially where they're good value and worth buying. But just from that diversification perspective, with bond yields this high, it certainly makes sense to allocate a portion of your portfolio into a bond bond fund at the moment.
Yeah, definitely. I think we maybe spoke about it last week, and I think maybe I wrote an article about this last week as well. It was that the equity risk premium both in the US and Australia is now extremely small because the earnings yield you get on stocks is just almost at par with the yield you get on long-term and safe bonds. And that definitely puts pressure on stocks when you can get pretty much the same return with pretty much zero risk. And I think now maybe the markets are sort of starting to realize. And I think that you sort of mentioned that this could happen, I think maybe two months ago, where we sort of showed the jaws of death, that graph that sort of showed the disparity between the stock valuations and where actual bond yields are heading. And I think maybe now the jaws are closing and snapping shut, and some fingers can get bitten off.
Well, it's interesting you say that, because in many ways the jaws aren't closing just yet. You've got bond yields that are continuing to fall, and the equity indices are starting to catch down to those falling bond yields. So we're not actually seeing a closing of the jaws. We're just seeing the equity indices starting to say, actually, we're really overvalued here. We've got a slowing economy. We've got a Fed that is taking liquidity out of the economy, rising energy prices, which is taking liquidity out of the markets as well. None of those things are conducive to risk taking, and that's what you're seeing at the moment. And the money's not going into bond funds. Clearly, bonds are continuing to sell off. So you've got this situation where equity markets and bond markets selling off at the same time, and that tells me that money's tight, and tight interest rates are pulling liquidity out of the market, and the whole risk-taking mantra has just disappeared in a matter of months. So perhaps let's look through some of the charts. We went through a lot of these last week, but I think we have had some pretty significant moves over the past week. So it's worth just sort of updating where we are. And I also wanted to show the RSI, which is a relative strength index, as an indication of how sort of far momentum is on the downside. And maybe just to start, before we look at the charts, just to give you an update on where we are in the CNN Fear and Greed Index. We are now firmly into extreme fear territory. So again, I think I've said this before, this is not necessarily a buy or a sell indicator purely from where this is, but it is telling you that sentiment is now extremely negative, and that is often conducive to at least a short-term bounce. But in saying that, a number of other things need to come together in order to suggest that we're at a capitulation low or a long-term bottom. So I think we might be at a level where we can bounce from pretty shortly, but in terms of capitulation low, I don't think we're anywhere near that, if that is indeed the type of situation we're coming to. So if you look at S&P 500, it's now trading well below the 100-day moving average here. It's tried to bounce back up a little bit, turning back down. So this trend looks now to be on the downside, is oversold, but that's oversold conditions are often a characteristic of negative trends and bear markets. This is the NASDAQ. Similar situation here. It's rolling over, made a lower high here and lower lows. So this looks like it's starting to roll over. Oversold here, bounced very in a minor way, and now it's coming back down again after the overnight. This includes Tuesday night's sell-off, which, as you can see, was nearly 2% for the NASDAQ, 1.8% 0.37% for the S&P 500. This is the Russell 2000, so like a small cap index. It looked like, if I just zoom out a little bit here, it did look like it was breaking out here as that momentum trade sort of started to get underway, but really quickly rolled over and is now back down to its lows from earlier this year and into last year. So that's given up any type of positive momentum it had. Just quickly run through Apple. Just zoom in a little bit here. Again, that's looking, looks like it's entering into a downtrend here. Microsoft, similar picture. Tesla looks like it's holding up reasonably well. But, I've looked at the valuation of this plenty of times and I just can't see how it can sustain that level longer term. NVIDIA, this is the pin-up stock for the AI and momentum trade, still holding up reasonably well in terms of this trend and these moving averages still intact. So you'd really want to see whether it holds the lows from 21st September if we do get another sell-off. And if it breaks through there, which I suspect it will, if the tech sector in general succumbs to these higher yields, then yes, I think you're going to see lower prices. This is the FANG index, which is the top 10 tech stocks in the world, or in the US markets really, which is pretty much the world. Again, moving lower, higher highs, higher lows, bounce from these oversold levels, but looks like it's turning down again. And just on the Aussie market, I thought this is interesting just to have a look at a couple of charts here. We showed this last week, how we saw the breakdown and that selling has continued. We are in oversold territory here. This is Wednesday morning, so the ASX 200 I think the futures are pointing to another down day today, which will probably push this momentum indicator down further. So I'd probably be looking at some sort of bounce purely from a technical perspective soon. But in saying that, it's held up better than say the US markets, purely because the banks are looking okay, and that comes back down to labor market, dysfunctional housing market, where you've got a huge amount of demand and lack of supply, which is holding up house prices. And it's worth pointing out that higher interest rates have crushed just about every asset price except residential property in Australia. Residential property has held up near its all-time highs, and that's obviously supporting banks' balance sheets, and the labour market strength is allowing people to maintain and service those mortgages. So that's shown in this bank index holding up. Now, again, if the economy slows, or continues to slow, I should say, to me, this looks vulnerable to another downside move. So we'll keep a close eye on that. But it's a large part of the reason why the ASX 200 has held up as well. And also the large resource stocks, maybe mostly the iron ore miners, have held up pretty well recently. And that has meant that the ASX 200 resources index has maintained above support here as well. Now, I'm expecting a sell-off here today, so you'll probably see a break below here. So again, bit of an ominous sign. And just looking at this, we talk about some jaws, looking at the jaws between the iron ore price and the Chinese yuan. Iron ore has continued to show strength, even though, we've seen a bit of a bounce recently, but even though the yuan US dollar exchange rate has been quite weak, and generally the iron ore price has followed that. So there's a bit of a gap here that is a concern. And if iron ore prices were to fall back down to here, they'd be back down below $90 a ton. I guess the other thing helping out is the weakness in the Aussie dollar. And I've got that down here, and it sold off nearly another % overnight down to a new low. And again, that's just an indication of weaker global economic growth. And in my view, an RBA that is sounding more like it's done on the interest rate front rather than the Fed, which still sounds really hawkish. And if we look at the effect of that on, say, the commodities.
Mhm.
And this is really where commodities are really hurt by real interest rates. So if we look at, we've talked about this before, but this is the TIPS fund, which is the inverse of real yields. So this is as the TIPS fall, that means real yields are heading higher. So real yields have spiked higher the last couple of weeks, and that's really hurting commodities across the board. So you've got gold here, gold's broken down. Again, very oversold. So maybe this sell-off for gold will see a bit of a bounce. Interesting, sometimes you do get false breaks from these consolidation ranges. So I guess the question for gold bugs out there, you want to look and see whether we bounce back up to this breakdown level and turn back down again, or whether we bounce back into the consolidation area. So that's something to look out for. Probability suggests it will turn back down, especially if this higher for longer narrative and trading regime hangs around for a few more months. So you want to just be cautious about trying to pick the bottom on that front, because we could see some more downside in the weeks and months ahead. Silver broken sharply lower there as well. Again, heavily oversold, so it's looking for a bounce. Copper is within this consolidation range. It hasn't broken down as yet, so that could be seen as a positive sign for copper, and it's holding above oversold levels. So that's a one to keep an eye on as well for the breakout or the breakdown. And just quickly going through oil, we know oil's been in a strong rally, got very oversold, and we were talking about not buying into and not following this rally, and it does look like it might be starting to correct lower a little bit, but still from a trend perspective that looks very healthy. And the main reason behind the weakness in commodities and the ongoing rise in yields is this strong US dollar index, and that's looking quite powerful, albeit overbought. So this is the opposite of the commodities and opposite a lot of the other trades, is that money's going into the US dollar and it's now overbought. So looking for a bit of a correction there, which would support a reversal and a rally in some of these oversold commodities. And just again on the tips, real yields heading to decade highs, and the similar thing there, the TLT, just about everyone knows about the biggest bond fund in the US, which is the 20-year plus Treasury bond ETF. That broke down over the last couple of weeks. Very, very oversold now. So I think this is what I was saying before. Technically, this looks like if you zoom out a little bit here, this looks like a very ugly chart. I mean, that is just not finding support anywhere. And I think if you go long term back, you have to go right back to 2007 since yields were this high. Fundamentally, I think it's probably a good opportunity to, and we've mentioned this before on the show, accumulating bond yields here. We might not be picking the exact low, but I think from a diversification perspective, buying bonds at these yields is not a bad move. Certainly, not betting the house on it, but just allocating a portion of your portfolio to that makes sense. And the Aussie bond fund, which is the BlackRock Australia iShares Core Composite Bond ETF. Sorry, it's a bit of a mouthful. That's actually held up pretty well. So even though you're seeing these bond yields surge, the lows were made back here in 2022. So for me, that's a positive sign. You're seeing very, very negative comments, negative narrative around bonds, yet the Aussie bond ETF is holding above the lows from, what do we got here, from both July and also back in October and back in June. So not a bad, I mean, we're still in downtrend here, but again, accumulating bonds at these levels, I think is a reasonably decent play. Just while I'm on these charts, let's just finish off with a couple that we showed last week, and this just supports again the fact that we're getting probably close to a short-term low. We've got ASX stocks that are now from an RSI perspective, and I can actually get rid of this RSI now.
Mm-hmm.
From an RSI perspective, we're getting 24% of stocks that are in an oversold level, and generally you only see that around these sort of big sell-off spikes, and the market has typically sort of rallied from that level. So we're getting there on that front. We're also getting there from the number of ASX 200 stocks that are above the 200-day moving average. More and more stocks are breaking down below that 200-day moving average.
Yep.
So again, not necessarily a short-term trading tool, but it's just showing you that more and more stocks are breaking down from their longer-term uptrends and now moving below the 200-day moving average, which is I guess a bit of a proxy for a longer-term trend. Again, from a shorter-term perspective, the number of ASX 200 stocks making new 52-week lows is back up to pretty high levels. And I think this was in September last year around the lows of the market. So we're not far off where that was. So this is, again, potentially at a tradable bounce. But this is the one for me that I tend to look at from a longer term perspective, and whether we're talking about capitulation lows or longer term lows, this is the ASX 200 stocks within 20% of a 52-week high. So effectively, this is saying that 60% of stocks are still in a bull market because they're within 20% of their 52-week highs. On the flip side of that, you're saying 40% of stocks are in bear markets. And at these lows last year, you had pretty much 30% of stocks that were in a bull market and 70% that were in a bear market. And that was more of an indication that we're at a longer term low because the market had been pretty much washed out, and many of the stocks are in bear markets. So I think we're still in the early days of that trend. Not saying that it'll get down to this level, but it's just something to keep in mind that we might be in the early stages of the majority of stocks sort of turning down from their highs, starting to go into downward trends, which is why I focus on, when I'm looking at stocks to recommend, I'm really focusing on stocks that have already been through that washout. Like I'm looking for ASX 200 stocks that have fallen 50% from their highs, have stabilized on the charts, might be looking at turn back up. Whereas if you can look at a stock that you might like and think, oh, okay, I wouldn't mind buying that. But if the trend has just started to turn down and it may be 10 or 15% from its highs, you might just want to be a little bit cautious about jumping on it. And just lastly, Kirill, to look at the Aussie VIX index. Again, this is not telling me we're at a capitulation low or any type of large amount of fear in the market. This is still a relatively well-behaved fear index. So I guess to sum all that up, I would say that we are relatively close to a short-term bottom just because the amount of selling that we've seen in the market has been pretty persistent over the past week. And we're getting many oversold conditions. You're seeing spikes in oversold levels. You're seeing increases in 52-week lows. All those common signs that a bounce is not far off. But with this interest rate mantra, higher for longer, and central banks really determined to inflict some damage, to me, I think we're a couple of months away from seeing the evidence that damage has been made, and for central banks to start to change their tune. I remember when we first started talking about this, I think we were midway through September, and we said, let's check in December and see whether that higher for longer mantra is still with us. So what are we now? We're roughly October. 2 and a bit months away from that. So we'll check in. We'll check in again and see how that's going.
Yeah, definitely. So I think from an investor's point of view, I think the news out there is a little bit negative, maybe a little bit more than negative. So how should investors maybe make sense of all of this right now? I think you've already sort of touched on it before, but is this a time for caution, for panic, or is this maybe a time for an agile stock picker to sort of get excited, or is this maybe a time to sort of hold off and maybe wait until real opportunities arise in maybe December, like you just said?
Well, I think it's to me it's always just a time to do what I normally do, which is try to analyze stocks, find good value, work out whether the forward projections are realistic, whether the consensus earnings forecasts from analysts are realistic, and then just try to find good companies to invest in longer term. These are the times that I actually get more excited about doing that. I think if we do get a change in that higher for longer narrative, I think you're going to see stocks like commodities, gold, Bitcoin, bonds, all those sort of really interest rate sensitive stuff, property trusts that have been really smacked down hard. You're going to see a bounce in a lot of those type of stocks, because I think there's an argument to say that they are good value. It's just that the interest rate environment is really seeing investors sell them down.
Yep.
So I get more interested in the market when there is a fear around and there's concern, because you know that when fear is priced in, you're getting good potential for future returns. When there's optimism and everyone's agreeing how good things are, there's just not a lot of it squashes and constricts your ability to generate good future returns. Fear is what allows you to generate future returns, but you've got to be able to buy the right stocks, find those stocks that are undervalued, and stick with them, even though the market might disagree with you for a little while. So I'm not rushing to get it to sort of buy things at this stage, but I'm certainly not panicking and saying, oh, we need to get out of this or get out of that, purely because the market's decided that, for the time being, they're not buying. And, I've got gold stocks in my portfolio. They've been knocked around for quite some time, but I'm getting increasingly excited about adding to those positions, purely because I think the correction that we've seen over the past few months has gone too far. And just in general, I think from a contrarian perspective, there are a lot of stocks that have been really knocked around. And if you sort of try to put aside this interest rate rising cycle and the fact that in 2 years' time, things are going to look a lot different, you can pick up a lot of really attractive companies around this time. This is the time to actually buy for a longer term portfolio. And we've been managing a model portfolio for our clients at Fatale Investment Research, and we've still got 40% cash allocation, and that has stood us in really good stead. We've outperformed the market by I looked at the numbers yesterday. We've got 6% outperformance since inception, which was in December 2021, and that's largely because we've remained defensive. But it's getting time where we can allocate that cash, because there's more opportunities that are starting to come up. So, long way of answering your question. Don't change anything. Have a process, and just stick to that process, and make sure that you're not being scared of executing on your process just because everyone else is panicking.
Yeah. And I think you raised a good point, because it's easy to get bogged down about interest rates and macroeconomic events. But at the end of the day, if you are someone who doesn't necessarily just buy funds but picks individual stocks, then it's not like you need to really pay that much attention to what's happening at the Fed or the Reserve Bank. There's still lots of great businesses that are just going about their day to day, and they're not necessarily worried too much about what the boards and central banks are doing. So if you can just maybe pick those businesses, then you should be fine long term anyway.
Absolutely. And that's why having that process is really important, because if you've got a process and you know what the valuation is, you can say to yourself, well, okay, well, this is what the market's thinking, but the market's not always rational. I mean, the market is a lot smarter than me. It's a lot smarter than you. It's a lot smarter than everyone. But at times, it's completely ridiculous. And that's when emotion comes into prices. And when you know that there's a lot of emotion in prices, and you see emotion at extreme fear and extreme greed, I mean, that's a good sign of when there's too much emotion in the market. You generally know that the prices are not reflective of long-term value. And the tricky thing is working out when prices are reflective of long-term value. That's the hardest part about investing. But I think this is a time to get excited and get interested. And I especially think, and I know you're off to London for a couple of weeks, so we are going to have a few different things on this podcast in the next couple of weeks. And one person I want to get on is James Cooper, who is our commodities analyst. And I just think there's a lot of great opportunities emerging, especially at the smaller end of the commodities market. So I'm going to get James on in the weeks ahead and have a chat about, where he sees those opportunities as well. So that should be fun.
Yeah, definitely. Well, I think with that, that's a nice way to finish up. So definitely look forward to those interviews, and make sure to leave a comment and like it. It helps us out. And feel free to comment if I've nodded too much or too little. And but as Greg said, I'll be off for a few weeks going to the UK. It'll be an exciting time.
Yeah, we'll have a good trip, and I'll be in the States next week. So I'm not quite sure how we're going to go about getting this podcast out. I might record something when I'm over there very briefly. But have a good trip, mate, and we'll see you. We'll see you in a month.
Awesome. Thank you, guys.
No worries. See you guys. Bye.
See ya. Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.